Today's topic is inventory valuation or stock valuation. Again, it's presented by Mr. James. First, we will look at the inventory records. We have two types of records, perpetual records and periodic records. The perpetual inventory records are those that are updated continuously after each transaction. Okay, periodic, you a count of the inventory is done at the end of the period, whether it's a month or a year, and then the records are updated at that time, but it's done at the end of a period. Okay, so perpetual inventory, after every transaction, when you buy some inventory, you would update your records immediately, and when you sell some, you update it again right away. Okay, periodic inventory, you don't update when you buy, you don't update, but you wait until the end of a period, probably a month or a quarter or a year, and you count up your stock that you have on hand and you value that and you update your records to that. Okay, so that is how the inventory records work. You have inventory valuation now. This is not just the records, we are looking at the value of the inventory or the stock. We have three methods of valuing it. In fact, there are much more than three methods, but for CSEC purposes, these are the three that we have to know. This first one is called first in, first out, and it is assumed that the first item of inventory bought is the first one to be sold. Right? Hence the name first in, first out. This is usually associated with the perpetual inventory. Right? So it is an assumption that is made. You may not necessarily issue them out in that order. Okay? But for valuation purposes, you will assume that the goods went out in that order. Next, you have what is called last in, first out. And here it is assumed that the last item of inventory bought or the last item of stock bought is the first one to be sold. Again, that is, you have to keep perpetual records if you want to use last in, first out. Okay? Now, notice this is an assumption. Nobody in their right mind will sell the last thing that they buy first. Okay? Otherwise, you will end up with a set of expired items on your shelf, right? From what you buy first. Okay, so this is an assumption for valuation purposes. Okay, right? Next, we have average costs, and the average cost of the items is taken as their value using the formula total cost of items divided by the number of items in stock. And this one is mostly associated with the periodic inventory. All right, you can also use it for perpetual inventory, but you find it mostly associated with periodic inventory. That's some work example. Okay, in this work example that we have here, exhibit 29.1, we have something that looks like a T account, a table. On this side, we have all the items that we bought and the date and the amount. This here is the pound sign. We will be using dollar signs instead. So we just change these to dollar sign if we copy it up. And on this side, we have the amount that is sold. So you are buying and selling this item. Okay. There is no opening stock in this. in this, but usually you will have opening stock. A quick check by the storeman showed that there were still 8 units in inventory at 31st December, which confirms that what the record show above, right? So if you bought 40 and you sell 32 here, you should have it in stock, right? Right. First, we look at the FIFO method, and it can be done in a table looking something like this. You have to have a column for the date, a column for when you receive or buy inventory. So you can see the word purchases here instead of receive. And then when you issue inventory from or stock from your supply that you bought here, you will also, sorry, just excuse me. All right. You can also see the word sales here for instead of issue and inventory after each transaction. So they're updating the inventory after each transaction. So this is a perpetual record, right? You can also see the word balance here to cover all these words here. Okay. Now, this has to be done in historical order. The dates January coming first. So when we look at the table here, we're going to put these items in historical order over in the other table. So the first item that we have is in January, we bought 10 at 30 for 300. Okay, so we come to our table here and we see we receive January 10 at 30. So the balance would be 10 at 30, 300, right? Then we look at the next item on our table here would be April, right? April comes before me, right? So then we bought another 10 at 34 each for 340. And we'll enter it in the receive column again, April 10 at 34, right? And in our balance here now, we have this 10 that we bought here at 30 each, 300, and 10 at 34, this bought here. And together they make up $640. Okay, so notice how it is done. You write back all the stock that you have, and each purchase is done separate. Okay, we look back again across here, and we see that our next date in order would be May, when we sold it for 50 each, right? And we come and we put it in here, May, we sell it. Notice we put in the it at the cost price. We didn't put it at $50 here. Okay? 8 at 30 each. So since we are doing FIFO now, our balance here would reduce, right? This 8 will come out of the first 10 up here. Because it's first in, first out, right? So we reduce this 10 to 2. Okay? So you have the 2 remaining here and this 10 from there. Okay? 10 at 34, 340. When we add these two, we get our balance now 400. Right? Our next item, the date is we buy 20 at $40 each, 800. So if we come in the receive column and we put it in October 20 at $40 each, right? So now we have the 2 here at $30, we have the 10 at 34, and we have this 20 at 40. So we add them down, we're going to get 1,200 worth of stock that we have in stock after this transaction. Okay, so our next transaction is going to be the last transaction in November, and we sold 24 for $60 each. And we bring it here and we're taking out the 24 here. Okay, but how it's going to come out? We sell the first in 2, then we sell the next 10, and that gives us 10 and 2, 12. So we have to get 12 more to make 24 from this 20 here. Okay, so we sell 12 at 40, 24. So out of the what we had here, 8 will remain from this 20. Okay, 8 at 40, the 40 from here, and that will give us $320. So our closing stock at the end of business using the FIFO method would be valued at $320. Right, again the table is set up the same way. Date, receive, issued, inventory after each transaction, and this column will remain basically the same because we are using the same data, and this will change slightly. Okay, but we'll go through it one by one and we'll look at it again. On January 15th, we buy 10 at 30 and we get 300. On April, we buy another 10 at 34. So now we have this 10 here and this 10 here. So we have 20 in all, but 10 of them are $30 each and 10 at 34. Or we add them together, we get 640. Right, now here we sold 8 of the amount. Now, although we are told that the price for selling that 8 is $50 each, right? We have to issue them at the last in, first out, right? So how we get this 34 here is we look at the last one that was in here, not up here. And we take this 8 out of there, so it's 8 at 34. If you take 8 out of it at 30, what you would be doing is using first in, first out. Right, this one here, see first in, first out, 8 at 30, right? So the 8 comes out of the last one that was in, and we will remain with 2 here at 34 each. So that's $68 plus the 300 up there.
No question, sir.
But
what the 50 gone?
What 50? The 50 is the selling price. That does not come into the value. You cannot value a stock as selling price. You have to value it at cost. In October, we buy another 20. We put it in here. So we have these 2 here. They'll bring them back here. And we have the new 20 at 40, 800. We add it on the 800 to the 368. We get 1168. Right? In November, we sell 24. Now look carefully how the 24 is coming, right? First, the last in, first out. So you get 20 from here. That's this 20 there, right? Then we get 2 from here, that's 22. We need another 2 from up here to get 24, right? So that's how they come out. 20 at 40, 2 at 34, and 2 at 30. And we have them here. 20 at 40, 2 at 34, and 2 at 30. And we get 24 here, right? So if we sell this and this, and 2 from here, we all will remain with this 8 from here, right? which is our 8 in stock here, and it is at $30 each. So 8 by 30 is $240. So the value of our inventory at the close of business on 30th of November using LIFO inventory method, last in first out, would be $240. Using the AVCO method, with each receipt of goods, as when you buy goods, the average cost of each item is recalculated. Further issues of goods are then at that figure until another receipt of goods means that another recalculation is due. So basically what this is telling you is that after any time you buy goods, the average cost would change. Why it would change? Because you are using the formula that we had here, total cost of items divided by the number of items, right? Anytime you buy items, your total cost will increase, right? And also the number of items in stock will increase. So your average cost will change, okay? And to change only when you buy goods. So we have a slightly different table. We still have the received and the issued here, but we have a column now for average cost, and we have a column now for number of inventory. And when we multiply the average cost by the number in inventory, we'll get this, which is equal to the same thing as the value of the inventory divided by number of inventory will give you the average cost, right? So anyhow you want to work it to get the figures in, right? But you must remember the formula, the total cost divided by the number of items that you have in on January we buy 10 at 30, so our average cost would be, our total cost would be 300, and we divide it by the number in units 10, we'll get the average cost of 30. Right? April we buy another 10 at 34. That's 340, and this 300 here gives us a total of 640. So we have 20 units. We divide the 640 by 20, and we get $52 per unit. Okay, that is the average cost. So you only need to have one line, not 3 and 2 and 3 and sometimes 4 lines like in the in this method here, right? May we issued some. Now we are going to issue it at average cost. So it's going to be 8 at the average cost of 32 that you have here, right? And you remain 8 by 32 minus from the 640, we will get 384. Or we can do it another way. From the 20, we minus 8 and we get 12. 12 by the average cost from here comes here, and you get 32. 12 by 32 is 384. Okay, so whenever you're doing it, make sure these 3 column balances, they fit into the formula. All right, October we have 20 being bought at $40. Right, 20 at 40 is 800. We add our 800 to our balance here, we get 1184. Now we have 20 that we buy here, and the 12 here giving us 32 in inventory. So we divide 1184 by 32, and we will get $37 as the average cost. In November, when we issue the 24 at 37, it would be at this 37 here. That is the last time we compute the average cost. And we will have 32 minus 24, 8 in stock, 8 by average cost of 37, give you 296. So what you will notice here, this is the value of the 8 units remaining in inventory using AVCO at the end of, right? This is a mistake here. That should be November, right? Therefore, 296.
Sir,
Yeah. Yes. Sir.
this table has come through up in the exam already, or we have to memorize it and draw it up?
Usually they give you the table, but they don't have to, right? They give you the table and you fill it in, but the table need not necessarily look like this, and it may not have headings. You have to put in the headings. Okay?
Yes, sir.
Right? So in a way, you have to memorize the table, right? But they will have similar things to this. Like I said, here could have purchases, here could have sales, and instead of number of units, you could have balance here, right? Have total cost here, and you could have average cost here, right? So things could be slightly different because there's no set rule for doing this. Businesses could make their records however they want to make it once they are following the standards. Okay, so we have that there. We want to look at what will happen to your profit if you're using the different valuation method. And the top here not showing. Here should be, up here should be FIFO. Here should be LIFO, and here should be AVCO. This column should be AVCO. Right. Now, what we want to look at is the effect of the inventory valuation on profit. Okay. Now we notice that each method we use, we got a different valuation for the stock, right? Inventory 240 and 320. Now, what we have here is an abbreviated trading account in 3 columns. Where the sales is 1840, where we get that figure from. From over here, we have the sales sold here, 1840. Okay, it would be the same regardless of which method we use, because the price of the stock is taken from when you buy, right? Okay, so I will minus the cost of sale from that. The opening stock, we didn't have any. The purchases will be the same for each method, and again we will get that from our table here. We have bought purchases 1440 here. Okay, when we add the opening stock and the purchases, we will get the goods available for sale. Right, this here should be 1440. Okay, we minus the closing stock that we get for each method. We got 320 for FIFO, we got 240 for and 296 for thing. Right, we can go back and take a look at it. 320 for FIFO, 240 for LIFO, and 296 for AVCO. We put it in the columns there. We minus the goods, the closing stock from the goods available, and we see our cost of sales 1120 here, 1240 here, and 1144 here. When we minus the cost of sales from the sales, we will get our profit. So 1840 minus 1120 gives us 720. 1840 minus 1240, okay, and this should be 600, not 640, right? And 1840 minus 1144 give us 696, right? So using different methods could determine what our profit is because we use the same figures, right? So using the different method could determine the amount of profit we make. And really, it's just paperwork because the profit that I make is still the same, right? Okay, you might catch that next week. But what you need to notice is that here on the table, the prices that we buy the goods at were increasing, right? So you have inflation there. And when you have inflation, FIFO method would give you a higher profit than LIFO and AVCO. Okay, when you have inflation, LIFO will give you a lower profit than FIFO. When you have inflation, AVCO will give you a profit in between these two. It's an average, right? Okay, and the situation would be reverse if you don't have inflation, if you have fall in prices, a recession or something like that, right? Okay, that's what you need to know as an accountant. This is the analysis of this, right? What happens when you choose a method of valuing your profit, your stock on hand, right? You cannot value it at the selling price. You have to value it at the cost, using the same cost figure, regardless of which method you use, but to have an outcome on your profit figure. The figure will look different, but